goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission, and we at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to our discussion.
Great.
Yeah,
Thank
he's
you.
not as
Chris
dovish as
Regaver,
what we thought.
Associated
This
Press.
was one of the
As you know,
possibilities.
Fed Governor Stephen Myron
right, that
has
he was going to be
continued,
opposite of what
kept
the
his
markets
position
are
at the White
expecting.
House, even as he's joined the Fed board. This is the first time, I believe, the Fed's board has had someone with executive branch ties in decades. Does this compromise the Fed's independence from day-to-day politics? And relatedly, how can you maintain the public's perception the Fed is politically independent with this dynamic? Thank you.
So we did welcome a new committee member today, as we always do, and the committee remains united in pursuing our dual mandate goals. We're strongly committed to maintaining our independence, and beyond that, I really don't have anything to share.
Okay, and then just as a quick follow-up, I'm sorry. You and other Fed officials have spoken extensively about the impact of tariffs on inflation, although perhaps with many companies appearing to eat the tariffs.
Yeah, exactly. This is what I was
tariffs may
talking
be
about,
impacting
that
the
he's
labor
coming
market and
out
other parts of the
actually
economy
hawkish.
instead. Do you see that as a possible outcome here, that tariffs are the reason we're seeing some slowing, particularly in the labor market, rather than in inflation? Thank you.
You know, it's certainly possible. You know, we're beginning to see, we have begun to see goods prices showing through into higher inflation, and actually the increase in goods prices accounts for most of the increase in inflation, or perhaps all of the increase in inflation over the course of this year. Those are not very large effects at this point, and we do expect them to continue to build over the course of the rest of the year and into next year. And you know, it's also possible that there may be effects on employment, but that I would say if you're looking at why employment is doing what it's doing, that's much more about the change in immigration. So the supply of workers has obviously come way
so
down. There's
one of the
very
key
little growth,
takeaways,
if any,
he
in
says
supply of workers.
the risk to
And at the same
inflation
time,
are
demand for
tilted to the
workers has also
upside,
come down
and
quite
risk
sharply,
employment are tilted to the
and,
downside.
to the point where we see
when we have
what
higher
I've called a curious
inflation
balance. It's, you know, typically
and
when we
we
say things are in
have
balance, that
weaker
sounds good, but
labor
in this
markets,
case, the
what is
balance
that, guys?
because both supply and demand have come down quite sharply.
Exactly, stagflation.
Now
So
demand
this is
coming
why
down
we're
a little
getting
more
this
sharply
reaction.
because we
This
now
is what's
see
causing
unemployment rate
the
edging
risk
up.
off market. He didn't want to say it, but higher inflation and weaker labor is stagflation. So this is why equity markets are dropping right now.
Chair Powell, do economic conditions and the balance of risks no longer warrant a restrictive policy setting?
So I don't think we can say that. What we can say is this, that over the course of this year, we've kept our policy at a restrictive level. And
Exactly,
people
Leo.
have
Like
different views,
definitely
but clearly
the trade
restrictive
deal,
level, I would
but
say.
I think this is going to
So,
be
and we
more
were able to do
about
that
Fed
over the course of this year
independence.
because
You know,
the
I
labor
think that's
market was
more
in very
towards
solid
that approach.
condition with strong
But
job creation and all those things.
Obviously,
I think if you
they
go
know
back to
behind
April and
closed
now look at
doors
the
what's going to
revised
happen
job
between China and the
creation
U.S. is
numbers
most likely
for
going to be
May,
more
June, July,
procrastination.
and August.
Right? When is the
You
deal
can
going to
kind of- I
happen?
can no
Probably
longer say
once
that.
Trump
So what that means
term
is
is up.
that the risks,
So
which
they understand that
the
part.
risks were clearly
But
tilted
that's
toward
that's
inflation.
definitely what's
I
causing
would
them
say
to
they're
wait and
moving
see to see how that goes,
toward
because that's
equality.
what's
Maybe they're not
impacting
quite out of
inflation
equality.
mostly.
We don't need to know that.
But
we
right
do know
now,
that
it's
they've
just
moved
like, yeah, I
meaningfully
like
toward
that's what's making
greater
him
equality, the
be
risks
cautious
between the
with
two
rate cuts too.
goals, and that suggests that we should be moving in the direction of neutral, and that's what we did today.
Under what circumstances would a larger than 25 basis points rate cut be warranted? And how seriously was that option entertained at your meeting this week?
There wasn't widespread support at all for a 50 basis point cut today. You know, I think we've done.
Well, right now,
we've done very
the
large
reason
rate
why
hikes
gold
and
is
very
not
large
rising
rate
is
cuts
because
in the
of
last 5
the
years.
stronger dollar,
And you
stronger
tend to do
yields,
those at a
right?
time
So he's just being more
when you feel that
cautious when it
policy
comes
is
to interest rates.
out of place and needs to move
So
quickly
it could
to a
cause
new
the
place.
dollar to
That's not at all
consolidate,
what I
but you
feel
can see that the
certainly now.
yield
I
is
feel like our
spiking up.
policy has been
So that's what's
doing the
causing
right
gold
thing
to push
so far
lower.
this year. I think we're right to wait and see how tariffs and inflation and the labor market evolved. I think lower job creation and other evidence of soft. Well, those but moving in the direction of balance now, and so that warrants a change in policy.
He said there was no widespread for support of a 50 basis point
Colby
cut,
Smith with the New
so
York
that's
Times.
not dovish
Should
at
we
all,
be
right?
viewing today's cut as the committee taking out some insurance against the possibility that the labor market is at risk of weakening? Or is it the committee's view that the dynamics of a downturn are already in place? I guess I'm just, trying to square the shift in the rate forecast in the SEP. Towards
and
more
plus
cuts
hawkish
than
and plus
just,
the stagflation,
3
but
months
it's more
ago
of
with
like
the
a
fact that
hawkish
the forecast
reaction
for
right now.
unemployment didn't
And
change.
you know that
Yeah,
Trump
I
is
think
right.
you
He'll
can think
come
of
out
this
and
in a way as a
pissed.
risk management cut, because if you look at the SEP, actually, the projections for growth this year and next actually ticked up just a little bit, and inflation and unemployment didn't really move much. So what's different now? What's different now is that you see a very different picture of the risks to the labor market. You've seen, we were looking at 150,000 jobs a month.
Yeah,
at the
but you
time
saw
of the
what
last
what I
meeting.
meant is
And
like
now we see the
it was
revisions
a
and we
higher
see the new
probability
numbers.
that Powell was going to
And
be
I don't wanna
exactly
put too much
different
emphasis
from what the
on
markets
payroll
were
job
projecting.
creation, but it's just one of
And
the
he
things
is
that
still
suggests
trying
that
to
the
stick
labor
to
market
his
is really
script.
cooling off. And that tells you that it's time to.
And it's also about like
to take
what
that
he's
into
not
account
also
in our,
saying.
you know,
He's
in our
not being
policy.
hawkish. He's not being dovish enough.
The SEP,
So
once again, the median
he's still
participant has
sticking to
inflation
his
higher than
script.
previously
But I
expected
like
by
equity
the end of
sales from a
next year,
stagflation
and the Fed
standpoint.
not
I
getting
think
back to the 2%
that was
target
the
until
good. That was the
2028.
signal.
So I guess I'm just wondering
him
how you
saying
characterize the
inflation
risk
is
of
high,
price
the labor
pressures
markets are
of
actually
kicking off
weakening.
a
That was a
series of
signal of
cuts at this point.
stagflation. So that's
Yeah,
a
so
good signal for equities
I would
to
look
push
at it this
lower.
way.
That was the sign for that.
We fully understand
Dollar,
and appreciate
be cautious,
that we need to,
because this could
remain
cause
fully
dollar to
committed
consolidate.
restoring 2%
But the higher
inflation
reaction is just
on a
because
sustained basis, and
he's
we
not
will
as
do that.
dovish enough.
At the same time, we've got to weigh the risks to the two goals. And I would say since April, to me, the risks of higher and more persistent inflation have probably become a little less. And that's partly because the labor market has softened, GDP growth has slowed. So I would just say that the risks there have been less than one might think. And in terms of the labor market, what we're seeing is unemployment is still low, it's still a relatively low rate, but we're seeing downside risks.
Michael McKee from Bloomberg Radio and Television. I'm a little confused by your explanation of the Fed cutting rates because of unemployment. If you think that most of what's happening in the employment area is related to immigration, which your rate cuts wouldn't address, how do you see that as more important than inflation, which has remained almost a full percentage point above your target?
Well, I was saying that what's happening in the labor market has more to do with immigration than it has to do with tariffs. That was the question I was answering. So I wouldn't say that all of what's happening in the labor market is due to tariffs. I mean, you clearly have a slowing in due to immigration. You clearly have a slowing in demand, which is now perhaps more than that in supply, and we know that because the unemployment rate has ticked up. So that's what I meant by that.
I can follow up. Every year since 2015, the SEP has forecast that you would hit your target 2 years later. And this year, this SEP says you're going to hit your target 2 years later. 2% does not seem to be in sight. Does that suggest that the 2% target is not really achievable? And does this present any credibility problems for you in telling people that that's what you're going to do if you can never reach it?
Well, I mean, you're right. It does say we're going to get to 2% inflation in 2028, at the end of 28. But that's literally how you put the projections together. You're writing down a rate path, which is designed to create, over the course of the SEP, time frame, 2% inflation and maximum employment too. So that's all that is. No one really knows where the economy will be in 3 years. But the nature of the exercise is to write down policy that you believe would return to the 2% goal over at least by the end of the exercise.
Thanks so
Yeah,
much,
definitely
Elizabeth
getting a
Schulze
strong.
with ABC
All right,
News.
so explain.
The latest inflation
So
report
during
shows that
the
prices
actual
are
numbers
still
that
going up
came out, the
across
dot
key
plot did
categories
come
for
out
many
lower.
households,
That's where we
including
got
groceries.
the actual dovish
What will the
reactions.
Fed do if
where
prices
Powell
pick up
started
more?
speaking. He's just not dovish
Well,
enough.
our
He's actually coming
expectation,
off a
and
bit hawkish
you
to the
can see this
markets, doing the
consistently
exact
through the year,
opposite.
has
He's
been that
confirming
inflation,
stagflation. All of this
will
stuff is
move
what's
up this year,
triggering
but
the
that
opposite reactions right now.
basically
Stronger
because of
dollar,
the effects on goods
weaker
prices from
equities, and
tariffs.
then we're seeing the
But
strength
that,
in the yields, and the
those will
dollar is
turn out to
also
be
pushing gold lower.
a one-time price increase as opposed to creating an inflationary process. That's been our forecast. Pretty much all the individual forecasts say that. we can't just assume that, though, right? We have to, our job is literally to make sure that that is what happens, and we will do that job. Right now, the situation we're in is that we see inflation, we continue to expect it to move up, maybe not as high as we would have expected it to move up a few months ago. The pass-through of the tariffs into inflation has been slower and smaller. The labor market has softened. So the case for there being a persistent inflation outbreak is less. And so that's why we think it's time for us really to acknowledge that the risks to the other mandate have grown and that we should move in the direction of neutral. So what will we do? We'll do what we need to do, but we have two mandates and we try to balance them. And so that for a long time, our framework says that when our two goals are in tension, and this is quite an unusual situation, how do we decide what to do? Because our tools can't do two things at once. What we do is we ask which is farther from, how far is each from the goal and how long is it expected to get to the goal? So, and then we think about those things and we see, as I mentioned, our policy had been really skewed toward inflation for a long time, really.
Yeah, again,
Now
guys,
we
if y'all
see
guys
that-
want a
that
better
there's
view,
downside
go
risk
on to
clearly in the labor market, and so we're
YouTube so you
moving
could
in the
actually
direction
see
of
the
a
full
more
charts
neutral
too.
policy.
How concerned are you about the slowdown in the jobs market for households at home, especially younger Americans struggling to land a job?
So it's an interesting labor market, and obviously we think it's appropriate that we reduce our rates so that we become more neutral, which presumably will be better for the labor market. You see people who are sort of more at the margins, so kids coming out of college and younger people, minorities are having a hard time finding jobs. The overall job finding rate is very, very low. However, the layoff rate is also very low. So you've got a low firing, low hiring environment. And the concern is that if you start to see layoffs, the people who are laid off there won't be a lot of hiring going on. So that could very quickly flow into
Yeah, you can see that the
into
dollar
higher
is
employment.
bouncing off that
In a
resistance area.
Healthier economy, healthier labor market, there would be
if start to
jobs
see
for those people. But
layoffs,
now the
it
hiring
could quickly
rate is
push up
very, very low.
unemployment.
So
So that's
that's
dovish
been a
too.
growing concern
So
over the
that's
last-
what's
last
helping
few
those
months.
reversals.
And it's one of the reasons why we think it's appropriate that we begin to shift our policy focus toward a more balanced one.
Steve Leisman, CNBC. Mr. Chair, in the past, during rate cuts, you used the word recalibration. And I wonder if you pointedly did not use it this time. And in fact, when you said policy is not on a preset course, did you mean that as sort of the opposite of recalibration? Are we meeting to meeting, data point by data point? Or are we in the process here?
It's a good question, but you know that Powell ain't gonna answer it.
So I think we're in a meeting by meeting situation. We're going to be looking at the data. Let me say a word about the SEP really here. So we often point this out. What the SEP is, it's an accumulation of the individual projections of 19 people, showing what they believe at a particular moment in time to be the most likely path for the economy and thus the appropriate path for monetary policy as well. And as you know, we don't debate or try to agree on what that is. We just write them down and accumulate them. We do sometimes discuss them. And so we always say we're not on a preset path, and we really mean that. The actual decisions we make are going to be based on the incoming data, the evolving outlook, and the balance of risks at the time the decisions are actually made. So you will have seen that we have 10 participants out of 19
Yeah, gold
who
is
wrote
just
down 2 or
melting.
more cuts for
He's
the remainder of the year.
like it's just
And 9 who wrote
he definitely
down fewer
switched up the markets.
then. In fact, in
And
a
that's
good number of
the
cases,
reaction
no more
from the
cuts.
press
So
conference.
rather than looking
So
at
pretty much afterwards, we're just going to be looking. It's going to be more data dependent stage,
to look at the
right?
SEP as
But
through
this is
the lens
the
of
direction
probability.
right now. What's
And-
really
and so
happening?
there are different
So
possible
he definitely
outcomes
switched it up,
and
gave us more of a
likelihoods rather
hawkish
than
reaction.
This one is
So that's
certain
why
and
we're
this one
seeing
isn't
dollar
happening.
rising,
So
gold
that's
is dropping.
what I
We're
would
seeing
say.
equities is pushing lower.
Thank you
And
for
he's
getting to my
sticking to
follow-up question,
he's sticking
which
to
is
his
the
stance too.
dispersion
He's just
in
not
the
dovish
outlook,
enough. He's not giving
a
us
sign of
anything
uncertainty of
to
policy
expect.
in the meetings to come. Thank
He's
you.
not really giving us anything to expect.
It is such an unusual
pretty much a
situation.
dovish reaction. He's not giving us nothing for that.
Ordinarily, when the labor market is weak, inflation is low. And when the labor market is really strong, that's when you got to be careful about inflation. So we have a situation where we have two-sided risk. And that means there's no risk-free path. And so it's quite a difficult situation for policymakers. And it's not at all surprising to me that you have a range of views. It's not
Yeah, good
so
job
much
with
about
the equity
having
sales.
different
That's my name.
views for the path of the economy,
Mac.
but it's
That's my name.
partly that. But it's also
But
partly
it should be
about
in the
what's the right
announcements
thing
tab.
to
You'll see
do
it there.
in light of the tension between the two goals. How do you weight them? How worried are you about one versus the other? And so it's natural. I think it would actually be surprising if you didn't have a pretty wide range of views based on, in this kind of highly
Yeah,
unusual
members
situation. We
took
do.
advantage
So,
of the gold buys that happened from
but,
the dot
you know,
plot,
we
and
get
then
together, we discuss,
took advantage of
we
the
have a great
UJ
discussion,
sells.
and then we
So it was
decide
a
what to
good
do and
move
react. But,
until
you're
Jerome
right
Powell
there,
speak. But
that
this was
it
expected,
is-
like
it's
I was
a
saying
wide dispersion
earlier.
of
That
views,
is
and I
a
think
higher
that's
probability
understandable and
that we're
natural
just
in
going to
the
get Jerome
situation.
Powell to say something different. So it's pretty good that he's actually
Hi,
following
Victoria
up
Guido
to
with
it.
Politico. You've talked
Yeah,
a
I don't
lot
think
about
these
Fed
directions will
independence
last.
and the importance of it over the years.
Because the labor markets
But
is weakening,
as
which he
markets
did
have
confirm.
questions about,
So I
what
think these
exactly
are just
President
setting
Trump's
up
intentions
better
are with the Fed,
positions
what
for
would you point to
a
as
dovish
the
Fed
things they
overall.
should
You
be
get what I'm saying,
watching
Carlos? So I
to
think that the gold
determine
buys
that
is
the
still
Fed
going to
is still
take
making
place.
decisions
This is just
based
giving us
on,
better positions for
the economic outlook rather than
dollar
political
sales
considerations.
in the future. So let's wait till
Look,
like the
it's
dust
deeply
settles.
in
We're
our
probably going to
culture
see
to
those
do-
opportunities
to do our
afterwards.
work based on the incoming data.
But
and-
equities, if the stagflation
and
is the
never
issue,
consider anything
I
else. That's just
I wouldn't say
everybody
like
who's
this
at
is
the
the
Fed
start for
really
the
feels
downside,
strongly
but it's a
about that way. So,
possibility. We could start seeing that big leg lower.
You'll know
in
it by the
in
way we
stock
talk
market.
about what we're doing,
because
by
the
the
stagflation
speeches that
was
people
the
give, by
main
the
concern
decisions
for
that
me.
we make. You'll know that we're just still
Like,
going to do that. That's
so
all
you
we
guys
do.
know, like stagflation, bad
And
for
we
the
don't-
stock market.
we don't frame
because
these
it's
questions
like
at all
him
or see them
saying
in
we're cutting
terms
rates
of
because we're afraid of
political
recessionary
outcomes. I
fears.
think when you get to another part of Washington, everything is seen through the lens of does it help or hurt this political party, this politician. That's the framework, and I think people find it hard to believe that that is not at all the way we think about things at the Fed. We're taking a longer perspective. We're trying to serve the American people as best we can. So I think you would be able to tell. I don't believe we'll ever get to that place. I would say we're doing our work exactly as we always have now. And people they're making their arguments, and we're having a great discussion around these challenging issues. So
Do you see the court case around Lisa Cook as
No, I
being
would say
related to questions of Fed independence?
I see it as a court case that it would be inappropriate for me to comment on.
Thanks, Mr. Chairman. Edward Lawrence from Fox Business. So we saw the preliminary benchmark revisions down 911,000. The revisions for June were the first negative revisions we've seen since December of 2020. How can the Fed base important decisions on rate and what to do with the interest rates on data that seems to be, as you called it in the past, noisy?
So on the QCEW, the revision that we saw was almost exactly what we expected. It was amazing how close the expectation was. So, and the reason for that is, for the last bunch of quarters, there's been almost a predictable overcount. And I think the Bureau of Labor Statistics really does understand this, and they're working hard to fix it. It's got to do, of course, it has something to do with low response rates, but it's also got to do with what's called the birth-death model, because a good amount of job creation happens around new companies and how many go out of business, how many get founded, and it's just really hard. You can't survey for that. You've got to have a model that predicts that. And it's quite difficult to do, especially when the economy is undergoing big changes. So, and they've been working on that and are making progress on it. But the data we get is still good enough for us to do our work. To the extent we have issues around data right now, it's about low response rates. That's happened all over really. Response rates are just lower to surveys now, both in and out of the government. And it's no great secret. We want higher response rates, and we need those to have, less volatile data. And the way to get that is to make sure that the agencies that collect the data have sufficient resources to drive higher response rates. It's not a complicated problem, but that's what it takes. It's not a mystery. That's what it takes. The other thing I'll say, Edward, is in the case of the job creation, the response rate is quite low for the first month, or lower for the first month. By the time you get to the second or third month, you're still collecting responses for that last month, for that prior month, and you get to the place where the data are much more reliable by the second and certainly the third month. So it's not that we don't get the data, it's just that we get it a little later.
If for the benchmarks, if that holds, it's 51% of the jobs that we thought were there weren't really there. Shows a weaker job market coming into this year. If you had had that information, would it have changed your mind related to where the interest rates should be? Should there have been a cut earlier?
You know, we have to live life looking through the windshield rather than the rearview mirror, as you know. And all I can tell you is we see where we are now, and we take appropriate action, and we took that appropriate action today.
Thanks, Howard Schneider. With
Yeah, not
Reuters.
really given an edge so far, but
as
he's
you
just
mentioned a
not.
minute ago, some
Again,
margins
he's
of the
just
job
not
market would
dovish
suggest
enough.
that the slide's
So
already
he's
happening.
given more of a
Black
hawkish
unemployment
reaction in
rate
the market.
August
So
was
that's
up
what's
7%,
currently going on right now.
Declining work week,
But
difficulty
pretty
among
much this is
college
the
graduates finding
direction.
work,
Okay, so
high
I do
youth
expect a little
unemployment.
pullbacks
Why
and
do you think a quarter
consolidation,
percentage
but we could just
point
continue
now
to see
is going to
if
arrest
anything
that?
else actually impacts the markets. That you
Well,
can say.
I hadn't say that I thought a quarter point would make a huge difference to the economy, but you've got to look at the whole path of rates, right? And the market's has already been baking in expectations. I mean, our market works through expectations, right? So I think our policy path really does matter, and I think it's important that we use our tools to support the labor market when we do see signs like that. I did mention that. You know, you see minority unemployment going up. You see younger people who are more vulnerable economically, more susceptible to economic cycles. That's one of the reasons, in addition to just overall lower payroll job creation, that shows you that at the margin the labor market is weakening. I would also point to labor force participation. Some part of the significant decline in labor force participation over the last year has probably been cyclical in nature rather than just the usual aging process. So we put all this together, and we see that the labor market is softening, and we don't need it to soften anymore, don't want it to. So we use our tools, and you know, it starts with a 25 basis point rate cut, but the market's also pricing in a rate path. I'm not blessing what the market's doing at all. I'm just saying it's not just one action.
As a follow-up
going
to that,
against the markets,
growth
too.
mix right now seems very concentrated in investment and on the consumer spending side in the higher income groups. Do you feel that that's an unsustainable mix for the economy moving forward?
I wouldn't say that. I mean, you're right. Those are two. We're getting unusually large amounts of economic activity through the AI build-out and corporate investment. I don't know how long that will go on. No one does. In terms of spending, you saw that the consumer spending numbers were well above expectations, and that may well be skewed toward higher earning consumers. There's a lot of anecdotal evidence to suggest that. Nonetheless, it's spending. So I mean, I think the economy is moving along. Economic growth is going to be 1.5% or better this year, maybe a little better. Forecasts have been coming up, as you can see. So labor market unemployment is low, but downside risks, but it's still a low unemployment rate. So that's how we see it.
Hi, Stephanie Rule, MSNBC. Treasury Secretary Scott Bessent has said that the Federal Reserve suffers from mission creep and institutional bloat. He's now calling for an independent review. Would you support an independent review, or are you open to any sort of reform in any areas of the Fed?
Of course, I'm not going to comment on anything the Secretary says or really any other officer says. So in terms of reform at the Fed, we just went through a lengthy and I think very successful process of updating our monetary policy framework. I would say there's a lot of work going on behind the scenes around the assets we have in the Federal Reserve Federal Reserve System and at the board. Are they the right size? We're actually going through a 10% headcount reduction through the whole Fed, including the board and all the reserve banks. The employment at the Fed at the end of that will be basically at the same level it was more than 10 years ago. So we will have had zero job growth for more than a decade when we're finished with that, and I think we'll probably do more than that. So I think we're certainly open to constructive criticism and ways to do our jobs better.
But not an independent review?
Not that thing on a list.
We're certainly open to always trying to do better.
Trump is going to hammer him. Just be prepared for
Mr. Chairman, Neil Irwin with Axios.
his Truth Social is
There's
going
been
to
some
be
debate lately
blown
on
up.
whether AI is already starting to affect the labor market in terms of lower labor demand.
Sales after this meeting,
higher
like
productivity by
I
contrast.
still
Uh,
like
do you-
overall,
do you buy
the
that?
Federal
And
Reserve
if
is
that
still going to
true,
be in
does
a
that have
dovish
implications
path.
for the monetary policy
So
So there's great uncertainty
expect
around
consolidation.
That. I think,
And then I still
my
expect like to
view,
see
which is
weaker
also a
dollar,
bit of a guess, but
stronger
widely shared, I think, is that you are
equities,
seeing some
stronger
effects, but it's
gold,
not the
probably
main-
once the
not
dust
the main
settles.
thing driving
Okay,
it.
guys?
And
So just give it time.
particular
Like, even though,
focus on
because
young people coming
it's
out
still going to be data
college,
dependent, but so far from what we got
and,
from the
yeah,
data,
there may be something there.
it's
It
still
may be
signaling
that
a
companies
dovish Fed,
or other
like especially with the
institutions
weaker
that have been
labor
hiring
markets. So
younger
that
people
still
right out of
signals
college
rate cuts.
are able to
So
use
just don't be
AI
like
more than
caught
they
up
had in the
because of
past.
these
That may be
moves.
part of
I
the
still
story.
think the bigger picture
It's
is
also
still a
part of the
dovish
story, though,
reaction.
that,
The
job creation
only
more broadly
concern
has slowed
that I
down. The
have is
economy
with
has slowed
equities.
down.
So I still like equities to
and
go
so
higher
it's
from
probably a number
an
of things, but yeah,
overall
it's-
dovish Federal
it's probably
Reserve.
a factor,
But
hard to
if the
say how big it is.
stagflation fears do continue, that's what's going to really dump the stock market. Make sense, guys? Put a one if that makes
Mr.
sense.
Chairman. What evidence
Because
do you see
they're not really.
tariffs
He
showing up
answered
in
everything.
inflation?
Well, if you can take goods, just sort of the broad goods category, and last year, goods inflation was negative. If you go back 25 years, that was the typical thing, was that goods inflation was, goods prices generally went down, even adjusting for quality. So that was not the case during the pandemic, of course. Goods inflation went very high. We essentially returned to zero or slightly negative inflation. Now, I think goods inflation over the course of the past year is 1.2%, which doesn't sound like a lot, but it's a big change. So we think, I mean, analysts have different views, but we think it's contributing, 0.3 or 0.4 or something like that to the current core PCE inflation reading, which is 2.9%. So it's contributing. What seems to be happening is that, the tariffs are mostly not being paid by exporters, mostly being paid by really the companies that sit between the exporter and the consumer. So if you buy something and you sell it through retail or you use it to make a product, you're probably taking a lot of those costs on and not able to pass it fully along to the consumer yet. That appears to be what we're seeing. All of those companies and entities in the middle, they'll tell you that they have every intention of passing that through in time, but they're not doing that now. To the
James.
consumer, the
Yeah, I
pass-through
can
has
tell it's gonna. He
been
don't
pretty
like
small.
these
It's been
reactions.
slower and later.
He's definitely
slower
not
and smaller
dovish enough.
than,
like
than we thought.
an
But
example,
the
he's
evidence
not
is- it's
confirming.
very clear that there's some
He
pass-through.
said that the 50 basis point cut wasn't
I also wanted to
pretty
ask
much wasn't a discussion.
If you could share with us,
He's not
the
really
conditions
talking
under
about
which you
more
might consider
rate cuts
leaving
coming
the Fed
in. The markets is not
May.
pricing in additional rate
I have
cuts.
nothing
So he's
new
just not
on
dovish
that for
enough,
you
know,
today.
just to give us that edge. He's just not giving it to us. But the rate cut did happen,
Katerina
but he's just not
Bloomberg
really
News.
giving
I
us
just
what we
wanted to
need to have
follow
that
up,
conviction
on, one
for
of
the
your
immediate
answers,
reactions
just a
right now.
couple
He's not
minutes
giving
ago.
that conviction to the markets.
We've often heard
So
you talk
it's-
about
I still
how
feel like
you
look
and
at
your
equities now,
colleagues,
as you can
do
see.
not think
I was
about
expecting this to
politics. This
happen
did not
probably
enter
once
the
he
room.
finished, but he's still
But one of
dovish
your
because
new colleagues, does
nothing
come
that
from
happened
this
so
world, right, where
far
everything is
signals
seen through this
him to
framework
want to pause rates
of,
anymore
of
because we
politics
are
and
seeing
of what party is being
even though
helped,
inflation
and,
is still sticky,
and that person is still
but
employed
inflation is
by
still
the White
lower,
House.
right? The labor markets
how
is
can
lowering. That's
markets
going to help
and the
inflation push
public,
lower too.
interpret,
So I still like the dovish reaction
some of
overall, like weaker dollar, stronger
speeches,
gold,
for
stronger
example, and
equities.
then some
But
of, the
I think it's
forecasts
going
that
to
we
probably
see
be
today.
some
I
good
mean, the median
opportunities once the dust
for
settles.
This year
Okay.
was moved.
It doesn't really
because
make
of the
sense
introduction
for
of
a
his
hawkish
forecast, right? I'm
reaction
talking about the
because
number of,
the only way it
rate
makes
cuts
sense
seen
for
this
them
year.
to take better positions
What
for
do
the
you,
dovish
what do you
reaction.
say to markets and the public
So that they're
are
not
trying to
buying
interpret,
NASDAQ and US 30 at
what
the
you guys
highs.
are
Now they
saying?
have better buy
So there's
positions
12
for equity markets.
19
Same thing for the
participants
dollar. Better
of
sell
the
positions.
12 vote,
You see
as
what
you
I'm
know, on a
saying? So
rotating
that's the
basis.
only
So
reason I can
no
see
one
this is
voter,
happening. Better buy positions for
can
gold.
really-
That's where,
the only way
that's
for
where
any
I'm
voter to
expecting
really
to happen moving forward.
move things around
unless
is to be
data
incredibly
changes that.
persuasive, and the only way to do that in the context in which we work is to make really strong arguments based on the data and one's understanding of the economy. That's really all that matters, and that's how it's going to work. And I think that is the way the institution, if that's in the DNA of the institution, that's not going to change.
And then I wanted to ask about a Gallup poll that showed that Americans now have more confidence in the president than the Federal Reserve when it comes to doing what's right for the economy. Why do you think that is, and what's your response? What's your message to the public?
Our response is we're going to do everything we can to use our tools to achieve the goals that Congress has given us, and we're not going to get distracted by anything. So I think that's what we're going to do. We're just going to keep doing our jobs.
Claire Jones, Financial Times. Given the range of views expressed prior to the meeting, I think there was a lot less dissent
She's crazy
today
as
than
fuck.
a lot
Like,
of
what-
people expected. It'd be good to know just what
Like,
you
what
think
they
the
expect them
drivers
to
were
say.
of coming to
Like,
that very strong
Trump is
consensus in the
stupid.
meeting.
Like,
and
what do we expect
also
them
on
to
the
say?
flip
You
side,
know?
to just explain why the
But imagine
plots are
what
really
he tells
so
his
scattered
personal
between
friends and his
one
colleagues and
expecting
shit. Like,
rates
I
to
can't imagine
end up
that.
higher by the end of the year to 5.
But yeah, like right now, we
What
can
were the
see
kind of
equities
range of
is
views you
spiking
had
higher,
about, on
right?
one
So
side,
it kind
why
of,
there was
yeah,
so
it's
much support
definitely
for a
mixed
cut
reactions
today,
after
and on
Powell
the
started
flip
speaking.
side, why
But
there's
this is
so
now,
much
like
divergence
instead
about
of
what comes next.
equities is spiking
So I think
up,
there's quite a
giving us
wide
that dovish reaction.
a wide
But we could probably see
assessment that,
if the yields in the dollar start
situation has changed
continuously
with respect
pushing
to the labor
lower.
market.
Let's see if
Whereas
that can
we could
happen.
still
But
say,
it's okay
and
to
did
just
say
wait until
in
after
July,
the dust
at the time of the
settles.
July meeting, that the labor market was in solid condition, and we could point to 150,000 jobs per month and many other things. I think that the new data that we've had, and it's not just payrolls, it's other things as well, suggests that there really is meaningful downside risk. I said there was downside risk then, but I think that downside risk is now a reality, and there's clearly more downside risk. So I think that's broadly accepted. And so that meant different things for different people. Some wrote down, almost everyone wrote down, supported this cut. And some supported more cuts and some didn't, as you will see from the dot plot. So that's just the way it is. I mean, people have, you have people who take this work very seriously, think about it all the time, do their work, discuss it with our colleagues.
So far,
endlessly
does
discuss
everything
this
make
in,
sense? What's happening today?
between ourselves?
Like,
and then
if
we
you guys
a
have
meeting where
questions,
we put
don't
it all
hesitate
out
to
on the table,
ask.
And this is what you get. And you're right. There's a range of views in the dots, and I think that's, like I said, very unsurprising given
If
the
you guys are
quite
good,
unusual,
like I'm not expecting much to
historically
happen no
unusual
more. Like
nature of the
we
challenges.
could
that
possibly
face.
see some consolidation
Let's
right
remember,
now,
though,
some
the
ranging
unemployment rate's
markets.
4.3%.
But
the economy's
dollar,
growing
I still like the
1.5%.
dovish reaction to hold.
So
because that's just the next
it's not a bad
step for
economy
the
or anything
Feds.
like that. We've seen
They're
much
not
more
going to hike
challenging
rates,
economic times. But
right?
from a
And so
policy
far,
standpoint,
nothing has been
standpoint
a
of what
signal
we're
for them
trying
to want to
accomplish,
continue
it's
to pause.
challenging to know what
Because
what
he
to
is
do.
confirming that the labor
There are,
markets
as
is
I mentioned
weakening.
earlier, there are no risk-free
So I still
paths
like the
now.
dovish reactions because
It's
of
not
that, because that's what
incredibly
the next
obvious
step
what to
should
do.
still be
So
continuation of
we
cuts.
have to keep
So
our eye on inflation.
focusing on
At the same time,
economic
we
data to
cannot
confirm
ignore,
that
we
is
must
going to be
keep our
key.
eye on
I expect the dovish reaction to
maximum employment,
continue
which is
after he
those are our
stops
two
talking,
equal goals.
and that's
And
probably
you
going
will
to, that
see
should
that
be
there
the
are just
direction.
a range
But
of
if we
views
get
on
consolidation,
what to do. Nonetheless,
don't be
we came
surprised by
together
it, because like
today
he
at the
wasn't
meeting and
overly dovish what
acted with
the
a
markets
high
is
degree of
trying to
unity.
force him to be, and that's really why. But if we see weaker dollar, weaker yields, expect gold to
Thank
push
you. Archie
higher,
Hall from
expect
Economist.
equities to push
You
higher.
mentioned earlier
If
that
equities
job creation's
start to
running
break
below
lower,
your guess
that's
at
going to
its
be
break-even
because of the
rate. I'd be
stagflation
curious to hear a bit
fear
more
is
about that,
becoming
where you
more
think
of
the
an
break-even
impact.
rate is.
Okay, so that's how you could tell.
So there are many different ways.
How you could tell
to calculate
stagflation is
it,
controlling the
and,
markets
none of them
is
is
that we have a
perfect,
complete
but,
risk-off market.
It's
Equities
clearly
push
come way
lower, safe
down.
havens gain
There-
strength. That's how you're going to know.
You could say it's
Okay, guys?
somewhere between 0 and 50,000, and you'd be right or wrong. I mean, there's just many different ways to do it. So wherever it was, 150,000, 200,000 a few months ago, it's come down quite significantly. And that's because a very lower amount of people are joining the labor force. The labor force really not growing much at this point, and that's a lot of where the supply of labor was coming from over the last 2 or 3 years. So we're not getting that now. We've got much lower demand. It's interesting that supply and
You see,
demand
he
have
just
really
said
come
it
down
again, too.
together so far, except now we do have unemployment ticking up outside, just one tick outside of the range where it's been for a year. 4.3% is still a low level, but I think this level of this speedy decline in both supply and demand has certainly gotten everyone's attention.
Follow up if I may. You mentioned
he never talked like that, so that's where that's definitely
striking
confirming,
that measures
you
of
know,
kind of activity and
that the
output
labor
for
markets
quarter,
is the
those that you
issue.
have seem pretty strong. The Atlanta Fed's GDP now is very strong. You mentioned strong PCE numbers as well. How do you square those things?
Yeah,
Is
it's
there a
break even,
chance
man. I
actually
wouldn't.
the upside risk to the labor
Don't
market if
overtrade.
those activity measures
Don't
are right?
overtrade.
Well, that would be
Vardo.
great. We'd love that to happen.
Opportunities will happen after.
So I don't know that you see a big tension there, but it's gratifying to see that economic activity is holding in, and it's a good bit from consumption. It looks like consumption was stronger than expected. What we got earlier this week, I guess. But and also we're getting, you know, a fairly narrow sector is producing a lot of economic activity, which is the AI build out and you know, business investment. So you know, we watch all of it, and I would say we did move up. The median for growth for this year actually moved up in the SEP between the June and September SEPs. So, and really the inflation and labor market didn't change much. It's really the risks that we're seeing to the labor market that were the focus of today's decision.
Yeah, so data to look for stagflation. If we see more labor data get worse, and then we continue to see higher inflation.
Given the cumulative impact of high interest rates,
Gold
on
is
the
just doing the
housing
opposite
sector,
of the dollar in the
I'm wondering
yields.
how concerned you are that current rate levels are exacerbating housing affordability issues and potentially hindering household formation and wealth accumulation for a segment of the population.
You know, housing is an interest-sensitive activity, so it's at the very center of monetary policy. When the pandemic hit and we cut rates to zero, the housing companies were incredibly grateful, and it was really, they said that was the only thing that kept them going, was that we cut so aggressively and provided credit and things like that, and they were able to finance because we did that. The other side of that is when inflation gets high and we raise rates, and you're right, it does burden the housing industry, and so rates.
All right, guys. So I'm not expecting him to say much. He's just repeating himself. Really,
we don't set mortgage rates,
the
but
questions
our
was all in the
policy
beginning. We
rate
pretty much
changes
got
do
what we
tend to
wanted.
affect mortgage rates.
So before I
that
go,
has been happening. And
any other
that'll,
questions
of
so
course,
far? I'm not expecting him to
demand.
anything else to
Lower
happen. The best
borrowing
option right
rates
now
for
is we do
builders.
got a hawkish reaction because of what he was saying so far, but we are seeing the break of the dollar. It is later in the day. It's best to just wait until Asian session, let the dust settle, so we could get a clear direction. We're gonna be looking at AUD labor data tonight, Leo. So I'll send a live link for that. We'll go live for that. But as of now, just be patient. All right. So he could still say something surprising, you know. So guys in the group, just go to the live stream. I'm gonna post it up, so you're most likely gonna hear him talk. But other than that, really, I still like the dovish reaction overall, but he just wasn't dovish enough for the markets right now to take advantage of it. So it just still doesn't mean you just exclude it moving forward. Just let the dust settle. Do not overtrade. If you took some profits, call it for the day. You won for the day. You know, so now let's just wait for other opportunities. All right, guys, be patient. Use good risk management. Yeah, there was a cut, Conquer. He did cut by 25 basis points. But it's just not he wasn't confirming 50 basis point cut, right? So he didn't confirm that. And pretty much the market expectations is not overly dovish. They're not expecting bigger rate cuts in the future. So that's why we got a bit of a pullback, you know, because he just wasn't overly dovish because it was already expected. You know, dollar was already dropping this whole time. Equities was already pushing higher. So he needed to really surprise us to give us those continuations, and he didn't. So that's the reason why. So pretty much it was on point. You know, we got the direction from the actual dot plot that gave the directions right away. And then when he came up, he just did the total opposite. So that it was literally called out as planned.